This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Attempting to challenge the belief he'll chicken out on tariffs, President Trump is ramping up the rhetoric. Is the market too complacent about the risks? What does history suggest about the sustainability of this tremendous surge off the April lows? Lots to discuss. Stay tuned. Welcome on board another edition of our Wise Investor Group podcast. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. Great to be back with you. I had a chance to get away with the family. Many thanks to Chase and Ann Summerson for doing a great job hosting in my absence. Hope you're having a great summer as well, taking some time to relax. But certainly the markets aren't relaxing. Tons of news flow that I want to get to. We just capped off almost a 25% rally. Almost a 25% rally in the S&P 500 off of the April lows. That's one of the greatest three-month rallies in history. In fact, it's the second fastest recovery, by my math, of a decline of that magnitude in 75 years, trailing only a kind of parabolic surge in 1982. So I know there's this kind of fear out there that, what goes up has to go down. But the reality is, obviously, anything can happen, but the reality is history suggests the opposite. History suggests that strength actually begets strength. And what we've seen recently is actually a bullish indicator, not a reason to get fearful, cautious, sell, stay in cash. According to Ryan Dietrich, he's a trader I followed for a long time, there have only been 5 other times in history when we're up 25% in 3 months. Only 5 other times that's happened. And continued strength was not only normal, there's never been a period where it hasn't gone up in the ensuing year. So just to give you some stats behind that, if you go back to 1975, again, 5 other times when you've had 25% in 3 months. The short-term numbers kind of mixed. In other words, 30 days later or within 30 days later, some periods you've been slightly up, some periods slightly down. But the further you go out, the more bullish the president is. Going out 3 months, average return of 8.6%. 6 months, almost 17%. 12 months, almost 22%. That's been the average. So again, it's a small sample size, right? But still, history suggests, like I said, that strength begets strength. If you're kind of a technical person, technical trader, just recently the 50-day moving average crossed above its longer-term 200-day moving average on the S&P. What does that mean in plain English? That the short-term momentum is so significant, it's creating a new kind of momentum trend going forward. And again, if you look at the historical precedent for that happening, going all the way back to 1950, according to the same guy, Ryan Dietrich, generally speaking, 3 months, 6 month, and 12-month returns are overwhelmingly bullish with high hit ratios. In other words, markets higher a year later when this has happened, 88% of the time. Higher 9 months later, 96% of the time. So, my caveat. Past performance is no guarantee or indicator of future performance, right? So take it with a grain of salt. But it would be an unreasonable position, in my opinion, to say that this is an indicator of you need to suddenly get fearful. Let's put it that way, okay? And by the way, if you take kind of a broader look at it, the fact that the S&P is very close to an all-time high, history also suggests you should not fear all-time highs. Not only, and what I think is very interesting about this is, according to JP not only are all-time highs perfectly normal, we've averaged about 20 all-time highs a year over the last 30 years, I think, but your returns are actually better when you invest at all-time highs than putting your money to work on any other day. So again, according to JP this is going back to 1950, if you invested at an all-time high, your return was 9.4% over the next year versus 9.1% on any other day. 3-year compounded return, 29.1 at an all-time high, 27 on any other 3-year period. And 5-year return, 50.2 cumulative versus 48.5 on any other day. So you get the point. All-time highs, strong momentum. I know, that doesn't mean we're going straight up, right? It doesn't rule out a period of consolidation. It doesn't rule out a correction. It doesn't rule out any of those things, particularly with everything going on in the world. But it should not be seen, in my mind, as a reason to suddenly change your positioning, get more fearful. Meanwhile, there's a lot going on, right? We know that there's been a significant ratchet up in the tariff kind of rhetoric again. I mean, I'll read to you a few headlines just from the last week to 10 days. Trump says 50% tariff on copper imports will begin August 1st. Trump threatens 35% tariff on Canadian goods. Trump to impose 50% Brazil tariff. Trump announces 30% tariffs on EU and Mexico starting August 1st. This is just within the last 8-9 days. So far, the market's been kind of shrugging that off. But again, if you look at it in totality, based on what we know so far, the weighted average tariff rate, by my math, is shaping up to be at least 21%. That's up from 15% as recently as July 1st. And of course, 2.5% in January. And a lot of tariffs haven't even been announced yet, right, on countries like Taiwan and India, nor have sectoral tariffs on pharmaceuticals, semiconductors that Trump has promised are coming down the pike. So the overall rate could go higher than 21%. Now, the hope is that those get negotiated down into the 15 to 17% range, I would think, but still much higher dramatically higher, of course, than what was expected at the beginning of the year, but even higher than what was expected 2 weeks ago. So this is something we're going to have to contend with. I think there are a couple things going on, right? One is that President Trump feels emboldened, right? With the passage of the tax bill, that was a major political win for the president, right? And that he feels that with that behind him, he has a little bit more political capital, right? And the other thing is the market's done well. And just listen to some of his quotes, right? He said, I can't remember the exact day, but I wrote it down. Quote, "I think the tariffs have been very well received. The stock market hit a new high today." And then he posted somewhere else, NVDA is up 47% since the Trump tariffs. NVIDIA's rally probably has nothing to do with tariffs, but he is associating the rally in the market with his tariff policy and that the market actually likes the tariff policy. So we have this kind of weird paradox. You've heard this TACO trade, TACO, which stands for an acronym for, Trump always chickens out, that his bark is worse than his bite. So you have this the paradox is that the market's been rallying for a lot of reasons maybe, but partly on the idea that he is going to chicken out, that he's throwing out these big numbers with the idea of settling for something a lot less. However, Trump might be seeing it the opposite way, that the market actually likes what he's doing. So we're in this kind of weird, perverse situation where, the market and the administration might be looking at this two completely different ways, which of course could add some pretty significant execution risks if the administration overplays their hand, right? And the reality is we're not going to really know the impact of this until later in the year. Yes, we've seen some impact so far in the data, but it'll probably be third and fourth quarter and maybe even 2026 before we really see the flow through of these tariffs into economic data. But certainly in the meantime, the markets are taking a very sanguine approach to it. But I will say, the idea that the market is overly confident and ebullient, I don't know if that's really showing up in the data either. So, for example, if you look at Wall Street strategists and their S&P 500 targets, at the beginning of the year in January, the average analyst's S&P 500 target was about 10 to 15% above the S&P 500. As of today, it's the exact opposite. the average target is actually below the S&P 500. So it's not like Wall Street has piled into this rally and has raised their targets and has gotten super bullish. And if you look at some of the consumer and investor sentiment data that I follow, like Investors Intelligence or the American Association of Individual Investors, which I've followed for a long time, the bullish readings are higher, of course, than they were 30 days and certainly 60 days ago. But they're not in like danger zone, like excessive optimism zone. So I still think this rally off the April lows is being viewed with a pretty healthy degree of skepticism, which is a good thing. You know, you've heard that cliche, right? The market climbs a wall of worry. Well, it's an accurate cliche. I mean, some cliches are valid, right? That's kind of what's going on. But again, if you look, going back to what I was saying a few minutes ago about the historical precedent, the 1 month signals after this type of surge are very much mixed, and that would be backed up by the calendar. If you look at, Strategas looked at this, the historical pattern of the third quarter for the S&P 500, going back to 1950, the first 10 days of the third quarter, which are already behind us, tend to be the strongest. Historically, you go into about a 30 to 45 day period of sort of consolidation. And consolidation does not mean the market goes straight down, but just a choppy period, which of course would be perfectly natural this time around, right? With all the anxiety around what's going to happen August 1st with the tariff deadlines. Of course, we're getting second quarter earnings, which is another source of market volatility. So we're entering, sort of, in their words, a lethargic part of the third quarter. The summer is often kind of volatile like this. So, long story short, do not be surprised if the market pulls back a bit. And we've seen a little bit of that this week, a couple down days this week. It would be perfectly natural and historically consistent, but I'm not sure it portends any big sell-off. I hope, could be wrong for sure, but that's what history says. So the other big thing, of course, and I just hinted at this, we're just starting to get the second quarter earnings. Now, again, to be fair, a lot of the tariff impact probably hasn't been felt because a lot of the tariffs haven't even gone into effect yet. So you have to take some of what you're hearing with a grain of salt. But I will say, going back to what I was saying about the market not being too ebullient, analysts aren't that ebullient either. Analysts have been taking down their estimates going into the quarter. So for the first quarter of this year, S&P 500 earnings were up about 13%, which was much better than expectations. Analysts have walked their consensus estimates, according to FactSet, all the way back to 4.8% for this quarter. I think they were as high as 8% about 2 months ago. So Wall Street is taking a more conservative position going into this quarter. And so that's a good thing, right? The bar, I mean, obviously the valuation bar is high, with the market at about 22 times earnings. But in terms of actual earnings expectations, the market is, or at least Wall Street, is expecting earnings to be a lot lower than they were in the first quarter, and estimates have come down for the rest of this year. Okay. But just a couple things to be keeping in mind. There are a lot of things. I mean, obviously, we follow individual companies, as you know, so we're going to be looking at what individual companies have to say. But from kind of a broader market perspective, there are going to be some things that we're going to be paying a lot of attention to sort of in the aggregate. One, I think, would be CapEx, capital expenditures. There's been a lot of talk, and I've talked, I think Chase has talked about how companies are kind of sitting on their wallets, right? I mean, the term uncertainty is hackneyed to say the least, but companies are definitely, the idea is that companies are hesitant to make big spending decisions with really no idea of what the tariff landscape is going to be. But if you actually look at the data, CapEx has still been at a pretty elevated level. Bank of America came out this week and said S&P 500 CapEx remained in the mid-teens in the first quarter of 25. Now, granted, 90% of that is driven by the Mag 7 and technology, AI-related CapEx. But even the rest of the market, even though it was relatively low, is still positive. So you are not seeing a big contraction so far at the market level, the aggregate, broad market level, in capital expenditures. The other thing, of course, the biggest thing that we're going to be watching is to what degree are companies absorbing higher prices. Goldman Sachs came out and said they expect companies to pass on about 70% of the direct cost of new tariffs to consumers through higher prices. And in the data we've gotten the last couple of weeks, we're starting to see that. Where you're seeing it really the most so far is in less frequently bought items like consumer durables that, for example, appliances. Appliances had the fastest increase in prices this century in the most recent CPI data that I read. Some of the more frequent purchases like food, yes, you've seen higher prices, but not as much. And so that's why maybe the average person hasn't felt it as much, because you're not seeing it necessarily to a great degree when you go down to the Giant or Safeway or wherever you're shopping. But you are seeing it if you're buying bigger ticket type stuff. Okay, so we are seeing companies pass through those costs. So the big question is going to be, what happens with profit margins? Because so far, at the kind of aggregate level, revenue growth has been a little better than earnings growth. But going back to Bank of America and the same piece that they came out over the last week, they really talked about the resilience of profit margins. I would argue that's been the single biggest reason the market has done well over the past 5 years. I mean, you can talk about AI, of course, and that's been a huge contributor, Mag 7, technology, but there are a lot of other sectors that have gone up over the last 5 years as well, and a lot of it has to do with corporate profit margins. They came into this year at an all-time high, and despite volatility in currencies, inflation, interest rates, it really hasn't rattled S&P 500 margins that much. And I think what's been very interesting is, we expected, and I think Bank of America expected, a lot of companies to essentially say, you know what? We're holding off on guidance. We don't know what our margins are going to be. We don't know what our earnings are going to be. There's too much uncertainty. That has actually not been the case. Most companies on the S&P have still been very confident making predictions about, how they're going to weather this storm. So I think what they talked about, and I think it's sort of an interesting term, there's been this sort of concept that American exceptionalism is waning, right? This idea that we're the best place in the world for capital and that we attract more capital than anywhere else. There's been this concept that that's been waning. Well, maybe that's true. I don't know. But what isn't waning, and I'm pretty confident in saying this, is the exceptionalism of corporate America, right? Corporate America. Companies are finding out how to adapt. And I think the lesson is corporate earnings do not equal the economy, and corporate America does not necessarily equal the economy. Strong companies have a lot of levers that they can pull through cost cutting, enhancing technology, productivity, a lot of levers that they can pull to keep their bottom line moving forward, even in adverse environments. And just to give you a couple examples, we don't own either of these stocks in any significant way in our portfolios. Neither do I own these personally. But Levi Strauss, we all know Levi Strauss. That's a company that you would think would be very susceptible to tariffs, right? Because so much of their raw material comes from overseas, particularly China. But if you look at their second quarter earnings announcement, their net revenues were up 6%. Their gross margin expanded 1.4% to almost a record, it was a record, 62.6%. Operating margin, a record as well. And they actually raised their revenue and earnings outlook. And the CEO told CNBC, we're absorbing some of the costs, and what helps is that our business is so strong. We've been pulling back on our promotions. That's leading to more full price selling. We have innovation, new fits, new product lines. That's attracting customers. That's what the management said. That's just an example. Another one is Delta Airlines, same thing. You would think that their business could be impacted, right? Are people cutting down on traveling? Immigration threat. All these things that might lead people to travel less. Air travel, from Delta's perspective, looks very healthy. Strong demand for transatlantic travel, strong demand for premium revenues, i.e. first class, business class. Corporate sales were up low to mid double digits, better than expectations. So listen, I know I'm cherry picking here. These are just two companies. But and maybe they have competitors that put up significantly worse results. But it's just a good example of those are two companies in very challenging markets that have been able, at least so far, not only to weather the storm, but raise their expectations for how they might do the rest of the year. Okay? So I won't belabor the point, but just be careful drawing a straight line between what you think about the economy, what you think about tariffs, and how companies might respond to that. And that's part of what we do. Of course, that's one of the reasons why we like individual companies in our client portfolios, is because we feel that we can find superior businesses that aren't going to perform every quarter, aren't going to make you money every quarter, but maybe have the ability to operate consistently even in challenging environments. If you are interested in looking at the bigger picture, the economy, the odds markets, if you follow Polymarket, which has odds on everything from the Super Bowl to the election to who the next Fed chair is going to be, those odds suggest the probability of a U.S. recession has declined from about 66% in April all the way down to 22% at this current juncture. So you might say that people are getting a little too comfortable, a little too complacent. That's very possible, but the odds have gone down, and we have never seen a U.S. recession where corporate profit growth has stayed positive. Okay, so if earnings do continue to come in the mid to high single digits, we've never seen a U.S. recession when that's been happening. We've never seen a U.S. recession without the unemployment rate rising, which we have not seen so far. And recessionary weakness in the U.S. labor market has never occurred in a vacuum. It's always been confirmed by weakness in other areas like business investment, CapEx, which we also haven't seen. So none of the things that, I won't say none of the things, but very few of the things that we typically see in recessionary environments are actually happening today. This could all change 3 months from now, 6 months from now. We'll be on watch for that, but I think those sort of draconian predictions of March, April, May, much less rationale and support for those at this point. But I will say, I think you have to be very cognizant of how you are positioned. I read something from Morningstar. They were quoting a recent study. I'm not sure when the study was completed, but it was a recent study from Natixis Investment Management that surveyed 7,000 investors with at least $100,000 in investable assets and asked them, what are your stock market return expectations over the next 10 years? And get this, the average was 12.6% per year, above inflation. Above inflation. Well, if inflation's running somewhere in the threes right now, then they're expecting nominal returns of almost 16% a year. Well, I'd be happy to be wrong, but I think the odds of the S&P doing 16 to 18% a year over the next 10 years are minuscule. Again, I hope to be wrong, but I think those odds are minuscule. So you've got an investing public that is expecting a heck of a lot from the S&P 500. So just be careful about the assumptions that you're making going forward. You've also got an S&P 500 that is as concentrated as it's ever been, all right? So I think the top 10 names in the S&P are now roughly 40% of the index. So just the reason I bring this up is know what you own. Make sure you know what you own. If you have a bunch of large cap funds, a bunch of index funds, unless you're diversified across value and small caps and international, good chance most of your portfolio is concentrated in less than 10 stocks. Let me rephrase that. Most of the performance in your portfolio is probably coming from less than 10 stocks. You might have 500 stocks, but the other 390 are contributing so little that the performance is really being driven by 10. So again, that's not necessarily a bad thing. I am not saying don't own index funds. I'm not saying don't own large cap U.S. growth funds. Just know what you own in terms of diversification, okay? I'd also say do a little bit of an emotional temperature check, right? If flash back to how you were thinking in April. If you couldn't sleep at night, if you were freaking out, if you were breaking out into sweats, and I'm not criticizing any of those reactions, okay? It's painful to be down 18, 19% in the S&P in 3 weeks, no matter who you are. But if you really were that uncomfortable, well, chances are, I can't manage your money through the computer, but chances are you've had some sort of rebound since then. May have been a dramatic rebound or may have been a modest rebound, but you probably had some sort of rebound since April. Maybe now's the time to rebalance. Maybe you shouldn't be 80% stocks. Maybe you should be 70% stocks. Again, I'm just throwing out ideas, but it's a good time. I've always said, the best time to rebalance is not when things are getting crushed. Best time to rebalance is when you're dealing from a position of strength. It's like insurance, right? You don't go out and buy insurance the day after your house burns down. You buy insurance when things are going well, right? When premiums are lower. That's the same, it's no different in the stock market. So take a good, honest assessment of your own emotional outlook on the markets, but also the way that you're positioned. Where are your concentrations? How much risk are you assuming? And would you be okay emotionally and financially if things went the other way, where you had not only bad markets, but also a different type of leadership in the market? All right, I'll leave it there for now. Up next, stick with me. I do want to give you the latest on some of what we're hearing from some of the positions in our portfolio, including a few that have already reported second quarter earnings so far. Back in a sec. Almost everything that lagged last year, value, international, and more defensive stocks, have held up relatively better here in 2025. Is this just a knee-jerk reaction or a more sustainable trend? Tune in every week as we discuss the latest financial trends and how to become a better informed, wise investor. Listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide, and should not be relied on for, investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to our Wise Investor Group podcast. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. We just started to get second quarter earnings, so I want to comment on a couple. Remember that the names that I'm about to talk about are names that we own in many of our client portfolios. Also, these are names that I own personally in my own investment accounts, so you can consider that a conflict of interest. If you're a client, I think you can feel confident that we've done our due diligence and feel that these are suitable for you to own. If you're not a client, please remember you really need to do your own research, consult with your own advisor to see if it's really something that fits what you're trying to accomplish. But so far, we have started to hear from some companies, particularly the large banks. Financials have been a good place to be. Really, if you go back to the November election, financials, I'm not sure they've had the best performance, but pretty close to the best performance of any sector in the S&P 500, particularly the large banks. So not so much the small to medium-sized banks or insurance, but the large cap, well-diversified, strong balance sheet names have been quite strong, and they were quite strong coming into this quarter. So, again, I'm not a technical trader, but I think when you have strong trends, any sort of hiccups probably could be considered more of a buying opportunity than a selling opportunity. That's generally the way things work there. I would also say, going back to what I said 5 minutes ago about the S&P 500 being so concentrated, that having some financial exposure diversifies you a bit. I'm speaking kind of in broad strokes here, but diversifies you a bit from, such a high concentration in tech, right? Because a lot of the tech names, as we all know, are trading at high multiples. A lot of the financials, I wouldn't argue that they're cheap, but much more reasonably priced and function much more sort of in the value type spectrum, more so than the growth spectrum. Wells Fargo is a name that we've talked about a lot over the course of the last few months. As you well know, they had some pretty significant governance issues a few years ago. This is going back to the 2017, 18, 19. And they came under a lot of scrutiny, regulatory scrutiny, and Fed scrutiny, and rightly so. They had a lot of issues there, made some significant management changes, and they really had the wraps put on them. Essentially, their balance sheet was frozen almost at 2017 levels, which really hamstrung their ability to grow their lending desk, really grow their balance sheet in general. Not to mention they couldn't return capital to shareholders, they couldn't buy back stock, they couldn't raise their dividend. Well, pretty much all of those constraints have been lifted. So, it's not going to happen overnight. Wells Fargo isn't going to suddenly spend billions and dollars, next quarter. So don't expect too much too soon. But Wells Fargo is, in my opinion, set up to be a much different type of company from a growth perspective than they were a few years ago. If you look at their most recent numbers, the Raymond James analyst had a pretty good write-up on this. The negative was their kind of net interest margins, if you will, which is a measure of kind of day-to-day profitability, were a little bit lower than what Wall Street expected, and they were kind of tempered their outlook going forward. A lot of that, though, is sort of a conscious decision on Wells Fargo's part to develop more muscle and marketing on their fee-based revenues, which tends to be lower margin business, more so than transactional revenues. But longer term, that's a good move for them. The fee-based business is a much more consistent, more predictable business that tends to command a higher multiple from Wall Street. But in the short term, it does bite their margins. So that was the negative. The stock was probably down about 5% since their print. But there were a lot of positives to consider. One is the uptick in loan growth. So as I mentioned, they are expanding their balance sheet. That's going to continue, I think, for some time. And favorable credit trends. There's really no sign of a significant deterioration in their loan book or credit card balances. So pretty good referendum on the American consumer in aggregate, still being in pretty good shape. So a lot of positives there. I think to take a balanced view, the negative, well, it's not really a negative, but the cautionary part of the story is that Wells Fargo now trades at a premium valuation. The Raymond James analyst has them trading at about 11.5 times their 2026 estimate, which is certainly a big discount to the market, but it's a premium to their large cap financial brethren, where the median is more like 10.7 times earnings. They're also trading at a slight premium to their tangible book value relative to their other large cap bank peers. So they are not the value name within the financial space like they used to be. They're certainly not super expensive, but that's probably, from a risk perspective, that would be one that, the bar for Wells Fargo is now a little bit higher than where it was. Then, of course, there are the macro risks of, layoffs, consumer deterioration. So we'll have to see how that plays out. But Wells Fargo, in general, the story is, I think, a lot more favorable there on balance than it was, several months ago. And they also have a very strong capital position. They are way above the targets that the regulators are mandating that they have. JP Morgan also reported earnings. They've always been, well, I won't say always, but at least in recent years, they've always been kind of the gold standard in the financial space, and you pay for that gold standard. They continue to trade at a premium valuation, which makes, again, the execution bar higher than maybe some of the more value names in the space. But again, you get what you pay for. They delivered almost a 21% return on tangible common equity, which is a measure of financial company, profitability. That's the highest in the space. So again, this is the Mercedes-Benz of the financial world. Good numbers. They did not see as much margin degradation as Wells Fargo did. Same sort of message about credit trends. Better than feared. In fact, they added about half as much to reserves as the Raymond James analysts thought that they might add. So the trends for large financial firms from a market perspective look pretty favorable. If you don't have any financial exposure, you may want to take a look. Just be aware that this would be a vulnerable sector in the event of an economic downturn. I haven't talked about Johnson & Johnson in a long time, but they quietly had a really good quarter. They beat revenues by consensus FactSet revenues by almost 4%, and they beat earnings by almost 3%. So best performance from them in quite some time. As you know, they've had a lot of issues, right? One, they still have this legal overhang from these talcum powder litigation issues. That's still out there. Secondly, remember they spun off their consumer products division into a separately publicly traded company, Kenvue. So the Tylenols, the baby powder, the Johnson & Johnson baby shampoo, all those products are no longer associated with J&J. So it's purely a med tech, pharmaceutical, and biotech company. But for the first time in a while, all those, the med tech and the pharmaceuticals, were tracking in the same direction. And of course, J&J does a lot of business overseas, and they've benefited from a weaker dollar. So the currency translation is much more positive. Now, as I would say with all pharmaceuticals, we're about to get some pharmaceutical tariffs from the Trump administration, probably within the next few weeks. So it's hard to get too excited about farms in the meantime, but J&J obviously has had a lot of time to make adjustments for that. I'll be very interested to see not only what the tariffs are, but what they're going to do to sort of, I won't say circumvent them, but manage them and also kind of appease the Trump administration in terms of maybe onshoring some foreign manufacturing. I will say the valuation is not that demanding, trading less than 15 times forward earnings, which is the cheapest they've traded in a long time. So again, be aware of the macro risks with tariff policy, but J&J is executing better than they've had in probably at least 4 or 5 quarters. The one other name I just wanted to mention briefly is NVIDIA. I think you all know who NVIDIA is. Well, they had some pretty favorable news recently. The CEO apparently met with the Trump administration. Maybe he met with Trump personally, I don't know. But if you recall, they were sort of, I don't say banned, but they were blocked from doing a lot of business with China. So if you go back to the first quarter, they recognized $4.6 billion in H2O sales. That was the main product that they were shipping to China. But they could not ship an additional $2.5 billion and guided for a negative revenue impact of $8 billion in this quarter. Well, theoretically, that's going to reverse. So, the RJ analyst looked at this and he thinks there's annual revenue potential of about $30 billion that could flow back to NVIDIA that analysts had to essentially take out of the model just a few weeks ago. So that's probably 30 to 60 cents a share in earnings. So that's a pretty significant tailwind for a company that, of course, already had a lot of tailwinds, right? And I think what we've been seeing with NVIDIA in the last couple months is a couple things. One is you're starting to see some real monetization of AI. Remember, that's kind of been the big concern, right? There's been all this massive capital expenditure on AI. In many cases, we haven't seen the return on investment yet, right? Well, that is starting to change. We're starting to see not only monetization of AI, but we're also starting to see pretty compelling signs of cost savings at the company level. And companies in their earnings reports are specifically pointing to productivity gains, efficiency gains, and margin gains as a direct result of AI spending. This is a somewhat new development, quite frankly. This is just in the last few months. So that, I think, portends a longer sales cycle than what maybe some analysts had feared as recently as a few months ago. Secondly, NVIDIA has been expanding their client base. Almost 65 to 70% of their business, according to Goldman Sachs, came from the so-called hyperscalers, which is essentially the other Mag 7 names, Google, Meta, I should say, Microsoft. They are expanding that, and specifically with sovereign entities, overseas investors, and some new kind of what they call emerging hyperscalers. So their client base is starting to expand in a way that was not the case a couple quarters ago. And there are other things to consider with NVIDIA, but certainly more tailwinds than headwinds. And the thing is their valuation is demanding, but they're only trading about 35 times earnings. So that's not crazy for a company with their type of growth, right? I mean, at the peak of the dot-com bubble, Cisco, I think, was trading about 200 times earnings without the quality of balance sheet that NVIDIA has. So am I saying go out and, start loading up on NVIDIA after a 70% move off the bottom? I'm not saying that at all. I'm just saying that if you don't have any AI exposure in your portfolio, that any sort of consolidation in the stock, you get some, any sort of pullback, you may want to consider the name and maybe consider that it's not as expensive as you might think. Obviously, there are risks to the story. Probably the biggest risk is just the overall demand environment. I mentioned how, yes, we're starting to see monetization, we're starting to see cost efficiencies, but these companies have spent so much money, we really need to see a pretty significant return on investment, right? So that would be the biggest risk, is this another Y2K buildup? Or is this kind of spending going to generate real returns and therefore justify more spending? That's the risk. So keep that in mind. So listen, we're only about a week into earnings reporting season. Over the next few weeks, both Chase and I, of course, will give you more, so stay tuned for that. In the meantime, as mentioned at the very top, I hope you're enjoying your summer, and I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.